The 2008 financial crisis was a global economic crisis that was triggered by a combination of factors, primarily stemming from the collapse of the housing market in the United States. It was one of the most severe financial crises in modern history and had far-reaching consequences for economies around the world. Now I will share a detailed explanation of the events leading up to and during the 2008 financial crisis. Background: housing bubble. In the early 2000s, there was a significant housing bubble in the United States. This bubble was characterized by rapidly rising home prices, driven by easy access to mortgage credit and speculation in the real estate market. Factors leading to the crisis. 1. Subprime mortgages. One of the key factors was the proliferation of subprime mortgages. These were high-risk loans made to homebuyers with poor credit histories. Lenders were incentivized to provide these loans due to the demand for mortgage-backed securities, MBS. 2. Securitization. Banks and financial institutions bundled these subprime mortgages into complex financial products known as MBS. These securities were then sold to investors worldwide, including pension funds, mutual funds, and international banks. 3. Ratings agencies. Failure. Credit rating agencies such as Moody's and Standard & Poor's played a role by assigning high ratings to MBS without thoroughly assessing the risks. This gave investors a false sense of security about the safety of these investments. 4. Excessive leverage. Many financial institutions and banks used excessive leverage, which means they borrowed heavily to invest in MBS and other risky assets. This amplified potential losses. 5. Lack of transparency. The complex nature of MBS made it difficult for investors to understand the underlying risks in these securities. This lack of transparency contributed to the crisis. Sequence of events. Housing market. Downturn. The housing bubble burst in 2006, leading to a decline in home prices. Many homeowners with subprime mortgages found themselves unable to make payments and faced foreclosure. Crisis spreads. As homeowners defaulted on their mortgages, the value of MBS plummeted. Financial institutions that held these securities, including major banks and investment firms, faced massive losses. This set off a chain reaction of financial distress. Bank failures. Lehman Brothers, one of the largest investment banks in the world, filed for bankruptcy in September 2008. This event sent shockwaves through the financial system and led to a loss of confidence in the stability of major financial institutions. Government intervention. In response to the crisis, governments around the world took extraordinary measures. The U.S. government initiated a massive bailout program known as the Troubled Asset Relief Program, TARP, to stabilize the financial system and prevent further bank failures. Global impact. The 2008 financial crisis had a profound impact on economies worldwide. Stock markets plummeted, credit markets froze, and businesses faced difficulties securing loans for operations and expansion. The crisis led to a severe recession in the United States and many other countries. Unemployment rates surged, and many businesses closed their doors. Governments and central banks implemented various monetary and fiscal policies to stimulate economic recovery. Interest rates were lowered, and stimulus packages were introduced to boost spending and investment. Long-term consequences. The 2008 financial crisis had lasting effects on the global economy. It exposed vulnerabilities in the financial system and led to significant regulatory reforms to prevent a similar crisis in the future, such as the Dodd-Frank Wall Street Reform and Consumer Protection Act in the United States. It also contributed to a wave of populism and distrust in the financial and political establishments. The crisis resulted in a prolonged period of low interest rates and unconventional monetary policies, which had implications for asset prices, income inequality, and the behavior of financial markets. In summary, the 2008 financial crisis was a complex and far-reaching event that originated in the U.S. housing market, but quickly spread to the global financial system, leading to a severe recession and prompting significant changes in financial regulation and policy.